Imagine a huge global shift that's quietly unfolding, one that could shape the next decade of investments. Money is moving, not into the usual places like the United States or Europe, but into emerging markets. And India is right in the middle of it. Now, why is this happening? Why are investors pouring billions into countries like India, Brazil, and Indonesia? And more importantly, what does it mean for your money, your rupee, and our economy? Let's start with a clear picture. Over the past year, the United States dollar has been getting weaker. At the same time, concerns over United States debt, high fiscal deficits, and trade tariffs are pushing global investors to look beyond traditional markets. What they're finding is a group of emerging economies with falling inflation, strong fundamentals, and much higher bond yields. In plain terms, it's like the big investors are moving from a low-interest savings account to a high-interest one, and India is one of those high-interest places. Now, here's where it gets interesting. India's government bonds have already started getting included in global indexes like the JP Morgan Emerging Market Bond Index, the Bloomberg Global Aggregate Index, and the FTSE Russell Emerging Markets Government Bond Index. These indexes guide how trillions of dollars are invested worldwide. As India is gradually phased into these indexes, all the big global funds that follow them are practically required to buy Indian bonds. That's not small change. We're talking about hundreds of billions of dollars in new demand. And the effect is already visible. Since these announcements, foreign investors have pumped in nearly $18 billion into Indian bonds. That's just the start. Analysts estimate that total inflows could cross $40 billion as index inclusion continues. It's like India just got a VIP pass to the global bond club. So, what are these investors actually buying? Let's break it down. A bond is basically a loan. When you buy a government bond, you're lending money to the government in exchange for regular interest payments and your money back later. The return you earn is called the yield. Now here's the key. India's bond yields are higher than many countries in Asia. Even after recent Reserve Bank of India rate cuts, our 10-year government bonds offer around 6.5% compared to 1.6% in China and 2.8% in Korea. That's a big reason foreign investors are interested. But it's not just about high returns. It's also about stability. India's inflation has cooled significantly, from over 6% in 2024 to around 3.2% by mid-2025. That gives the Reserve Bank of India room to cut interest rates, which they've already started doing. Lower rates usually mean higher bond prices, which investors love. Plus, with inflation under control and growth steady, India offers both safety and profitability. That combination is rare. Now let's take a step back. Why should this matter to you? Because when foreign investors buy Indian bonds, demand goes up. Bond prices rise and yields fall. That means the government can borrow money more cheaply, freeing up funds for infrastructure, healthcare, and growth. It also strengthens the rupee. More dollars coming in means less pressure on the exchange rate. A stronger rupee makes imports cheaper and helps control inflation further. This also ties India more closely to global financial markets. When you're part of these big indexes, money flows in more predictably. But it also means we're exposed to global volatility. If there's a major event abroad, a war, a rate hike in the United States, we might feel the ripple effects in our markets too. At this point in the video, if you're still with us and finding this valuable, make sure to subscribe. We break down complex financial stories like this in simple, clear language, and there's much more coming up. Subscribing helps the channel and keeps you ahead of the curve. So, where are we headed? India is now on track to become the second largest emerging market bond destination after China. Since the index inclusion announcements, inflows have already crossed $18 billion, and experts estimate the total could go beyond $40 billion as the process continues. We're witnessing a deepening of our bond market like never before. But here's the takeaway. This is not just a financial upgrade. It's a vote of confidence. The world is trusting India with its capital, expecting us to manage it wisely and deliver stable returns. To sum it up, global capital is rotating. The money that used to chase United States assets is now looking to countries like India, because here they see growth, yield, and macro stability. Our bond market is the new destination. And as investors, citizens, and professionals, we're at the center of this transformation. If you found this video insightful, drop a like, share your thoughts in the comments, and don't forget to subscribe. Let's continue decoding finance together. Until next time, stay curious, stay informed,